Welcome to the Canadian Investors Course, Session 17, Psychology, You and Your Advisor Commentary. Remember, this time it's on slide 3, Terms of Use and Disclaimer, which was read to you in full in the introduction. But here we are at the end of our journey together. This is the end of the Canadian Investors Course. It's the last segment. The Beatles tune that we were thinking of was When I'm 64. Of course, I realize it's now that I'm 64. Maybe some of you realize you wish you were 64. We're humans and we love to do things together. We like to be with the crowd. We want to be going the same direction. It feels more comfortable. Not unlike sheep. So does all this sound familiar? Toronto CBC story in 1988. Toronto prices were through the roof in 1988. A buyer in 1988 was disgusted with the average sale price of $229,000. We all know the Toronto housing market's hot right now, but did you know people were freaking out about it in 1988? A CBC television story by reporter Neil MacDonald was very telling. Just look at what the former vice president of a real estate firm said at the time. It's a terrible sentence to move to Toronto from a point of view of finances. Pretty harsh, but in 1988 the market was hot and people were worried about it. Neil's story starts like this. Nice, we'll always have that, but there's bad news. And it will sound very familiar to the people who are buying a home in 2017. Canada has become Canada's golden city. Toronto's become Canada's golden city. To crack the housing market, Toronto's core, you now have to be wealthy. In 1988, you had to be wealthy to buy downtown. Makes you wonder what you have to be now. Anyway, real estate prices were high, and people in 88 were not having it, even if they landed a good job in Toronto. That's Ben from London, Ontario. He's a professional and a family man. His kids were not impressed with CBC News in their kitchen. In 1988, Ben found a higher paying job in Toronto. Company even offered him an interest-free second mortgage. Came to the city to check out houses, and disgusted Ben balked at the high prices, passed on a job, and stayed in London. 1989 until 2001. That's how long it took to see 1989 price on a house that you lived in the Toronto area. So those who say that real estate prices can't go down just need to check out history, because they have certainly done so in the past. Of course, as we've said many times in this course, maybe it's different this time. So let's look at ETFs. 40 billion in ETFs. It's not a record, but a really big month. That was February 2, 2017 at 2:08 p.m. on News Channel. The latest data from ETF market shows that investors were a little less America first in January, and they were in a record-setting December 2016. Investors poured more than 40 billion into ETFs in January 2017. Still a big month, but for a change, the U.S. market wasn't running away with post-election investing dollars. December had set a monthly record for ETF flows at $60 billion. January was notable for investors balancing their bets. Overseas stocks and bonds received investments at a level that was close to U.S. stocks. The $15.5 billion that came into U.S. stocks and ETFs in January was well below the $47 billion that taken in by these funds in December, according to monthly flow data from FactSet Research. In January, international stock ETFs and bond ETFs almost kept pace, each taking in more than $12 billion from investors. By the way, remember what we said about bond prices and bond yields in the course? This is something for you to pay attention to if you want to be a wily investor. Stocks are getting incredibly expensive. So the question is, are we in a bubble? Or are things different this time? Investors are paying more for earnings on average today than virtually at any other point in history, if you look at the Shiller P index. The only other times that P ratios have been this high were during pre-market crashes, such as the dot-com bubble, Black Tuesday, and the financial crisis of 2008. If history does in fact repeat itself, right now could be a particularly dangerous time to invest. Right now being summer of 2017. So back to Cramer, the ultimate showman. But you know what? When you listen to Cramer, if you listen to him carefully, he does tell you the whole truth. He does warn you. But he says, look, the market's doing this. So if we're following the trend, we got to be on the trend, which means we have to buy. Teutonic shift in the market means buy, not sell on a rate hike. In the past, a rate hike would have been an indication that you should trim. In today's market, a rate hike means that they're doing what they said they were going to do, buy. February 1980, customers line up at Denver Gold Exchange to buy coins and bars of gold. 1980 had, all of a sudden, the price of gold spiked. And then look what had happened to it since. Now, you look at it, and an AOL Finance article, February 5th, 2017, gold is the worst investment in history. Well, it's true. If you bought gold back in 1980 and you sat on it for almost 20 years and it did nothing, then finally it spiked recently, and now it's back to 1980 prices. So, really, you would have been better off buying almost anything else. Nobody wants to be the bearer of bad news. Nobody wants to crush people's dreams. But in the world of investing, cold hard facts, not dreams, are what make your money. And the fact is, historically speaking, buying gold is the worst possible investment you can make. Amazing how psychology has turned upside down. So the question is, if the world is saying that, and we know that it's basically all the sheep that are following that, what should you do? Is it time to buy? Anyway, let's look at the next couple of slides. 1929. Stock market invincible. Buy, 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 experts advised on the front page of the newspaper. So people were terrified of not being in the market because they didn't want to miss the opportunity. So they had a terror of selling. They wanted to be there to take advantage of what all their friends had benefited from. And what happened? Same thing. October 1987. Stocks plunge 508 points, drop of 22.6%, 604 million volume, nearly doubles record in the New York Times. Bear market, stay out. What happened after October 1987? Market took off again, didn't it? So, this comes back to the roller coaster of investor emotion. You got to remember that when you're feeling panicky, fearful, depressed, you're going to capitulate, and you're despondent, that's probably the point for maximum financial opportunity. And when you're excited, optimistic, thrilled, in fact, euphoric, that's probably when you should be saying, wow, if things are this great, they probably can't get any better. Maybe it's time to trim a little bit. So, in other words, if your emotions are telling you it's wonderful, maybe you should question it. If your emotions are telling you it's awful, maybe you should question it. Anyway, it's been nice narrating this course for you. If this course has asked you 50 questions that still need to be answered, go back and look at the sessions and see if you can get the information out of them. But this course is really the beginning. We're at the end of the course, but it's the beginning for you. And what you probably realize you need by now is a wealth professional you can trust, a trusted wealth professional who you can work with in harmony and bounce ideas off of, listen to each other. That trusted wealth professional may actually deter you from making some of the investments you might be tempted to make, which certainly won't make you money. But if it doesn't lose you money, in fact, it protects you from losing money, it has made you money. Anyway, if you look up you go to the locator, you plug in your postal code, you can find a trusted wealth professional in your area, go and talk to them, see if there's a fit. If there's not, call Jerry, the phone number is right up on the screen, and maybe he can help you find an alternate. Anyway, it's been nice chatting with you, and good luck with your investing future.